Yes,
Thank
good morning
Eero.
to you all. And I can confirm this is definitely the right place to be this morning.
Okay, good.
Yes. So maybe I will open the webinar today. Welcome to you all. And we very much like to see you all here today in the Finance Finland Roundtable on the completion of the Banking Union. My name is Mari Pekonen-Ranta and I am the Director of EU Affairs in Finance Finland. And I will soon give the floor to our Managing Director, Piia-Noora Kauppi, who will go through the program and speakers of today. But I will just quickly show you the slide on some practical and technical guidance on the webinar. You are just completely everyone knows this kind of guidance, but then we would ask you to be active in Twitter, and we invite you to tweet about the event, and you can see the hashtags over there. It's hashtag Banking Union and hashtag FFI Roundtable. But now I would ask Piia-Noora to continue and present the program and speakers of today. Thanks.
Thank you, Mari, and welcome also on my behalf. So my name is Piia-Noora Kauppi. I'm the Managing Director of Finance Finland, and I'm very happy to welcome you all to this roundtable, which could not be more timely. The EU's banking union was created as a response to 2008 financial crisis. The banking union aims to ensure that the banking sector is stable and safe. Banks should be robust and able to withstand possible future financial crises as well. At the same time, non-viable banks should be resolved without recourse to taxpayers' money, and the bank sovereign nexus should be broken. Currently, the banking union consists of a single supervisory mechanism and single resolution mechanism. In addition, we have a deposit guarantee schemes directive, ensuring that the level of deposit protection is largely harmonized across the EU and the banking union. An essential element of the banking union and EU's financial regulation is the single rulebook, which consists of a set of legislative texts that are applied to all financial institutions. The aim of the single rulebook is to ensure that banks are regulated according to the same rules in all EU countries. Although the banking union has been up and running for several years already, it is not yet fully complete. In 2015, the Commission gave a proposal about the European Deposit Insurance Scheme, EDIS. Since then, the discussion has been going on whether there is a need to establish it, and if yes, in which format. Could a temporary liquidity support system be enough? Or is loss sharing an unavoidable part of the future EDIS? And could a hybrid EDIS with national deposit guarantee schemes and common central fund be possible? In addition, also the crisis management framework is seen as incomplete. The national banking insolvency regimes vary considerably across member states. And the application of EU state aid rules in banking crisis has raised question marks several times. Recently, there has been discussion about the need to establish an EU bank liquidation framework for small and medium-sized banks, which are mainly deposit financed and possibly not able to emit MREL instruments, which are needed in resolution. There are also other topics on the table, including greater integration of the EU banking sector and the question about home-host balance. A very hot and difficult topic is a regulatory treatment of sovereign exposures. Should there be non-zero risk weights also in the future, or perhaps quantitative limits to these exposures? In December 2020, the Euro Summit invited the Eurogroup in inclusive format to prepare on a consensual basis and stepwise and time-bound work plan on all outstanding elements needed to complete the banking union. This work plan is expected to be presented to the next Euro Summit in June. At the same time, the Commission is preparing legislative proposals for the reform of the crisis management and deposit insurance framework. These proposals are due to be published by the end of this year. The Commission has also launched an extensive public consultation on this topic. So that is why this roundtable is very timely. And in this roundtable, we have asked the prominent representatives of the European Commission, European Parliament, and the Finnish Ministry of Finance to give their views about the completion of the banking union. I will present the speakers when it's their time. And the first keynote will be coming from European Commission. It will be Mr. John Berrigan, who is a Director General of DG FISMA. And of course, you know that John has been working for the European Commission already since mid-80s and has spent most of his time working on financial sector issues. He was, for example, Secretary General of the so-called famous Giovannini Group, which worked with the euro-dominated debt issues and post-trading in EU countries. He has also worked at the International Monetary Fund and, of course, in the predecessors of FISMA in DG ECOFIN. Currently, John represents the European Commission on the Economic and Financial Committee and the Financial Services Committee, which report to the EU finance ministers. He is also Commission representative on the FSB board. And he attends to the European Systemic Risk Board as a permanent observer and also as a permanent observer on the Single Resolution Board. So he is truly an expert on this topic, and we are delighted to have you here, John, and I will give you the floor. The floor is yours.
Thank you very much, Pia, and good morning, ladies and gentlemen. I'm, of course, very happy to participate in this debate, which focuses on one of the Commission's key priorities in the financial services field, which is the completion of the banking union. The completion of the banking union, has been on the policy agenda of the EU for quite a number of years now, and I think we have to admit that after a strong start between 2010 and 2015, progress with banking union has been undeniably slow. But the ongoing COVID crisis, I think, just like the global financial crisis before it, highlights the opportunity cost of not having completed banking union and not having a fully complete banking union in place. So what has been noticeable, as been mentioned already, is that political momentum is again gathering behind the project. Now, I'd like to begin my introductory remarks this morning by briefly considering the impact of the COVID crisis on the EU banking sector by way of background to discussing the ongoing work on banking union here in Brussels. So, EU banks entered the COVID crisis in fairly robust condition, and that was mainly due to the major reform effort after the last crisis. And this robustness, I think, has allowed them to continue lending to businesses and households despite the effects of repeated lockdowns on economic activity levels. Now, of course, bank lending has been facilitated also by central bank liquidity injections, by state guarantees for borrowers, the release of prudential capital buffers, and a degree of regulatory flexibility. But I think there's no doubt that even these support measures would not to support and maintain lending back in 2008, 2009. So I think we have this mantra now. It's a mantra, but it's true that banks are this time part of the solution, but not part of the problem, but we need to keep it that way. Now, looking forward, analysis suggests they're good enough to weather the shock that was associated with the pandemic. But as I said, we can't just be complacent about this. Now, since 2016, the volume of non-performing loans on bank balance sheet has declined substantially across the EU. At the end of 2019, the EU-wide NPL ratio had fallen to about 2.5%. Although the distribution across member states, of course, is not even. That NPL ratio stayed rather stable throughout 2020, despite the increase in bank lending and amid the economic lockdown. So clearly the stabilization in the NPL ratio reflects the effects of the various support measures for borrowers and the bank's response to that. So this would suggest that the underlying, or let's say the hidden trend in NPLs is likely to be much less favorable. And as we enter the post-COVID recovery later this year, we can expect an inevitable wave of corporate and household insolvencies as the various support measures are gradually withdrawn. And this wave of insolvencies will translate into higher NPL ratios for banks, albeit with some time lag. Now, in a worst case, but nevertheless plausible scenario, the ECB has projected that NPLs in the euro area could reach up to 1.4 trillion euros. Now, this would be well above the levels seen during the great financial crisis. So at the end of 2020, the Commission adopted a communication on NPLs. That communication set out measures that can improve the environment or the ecosystem, let's say, in which banks can dispose of non-performing loans should they begin to accumulate. And it's worth noting on this occasion that this wave of NPLs is likely to hit all of the member states and not just a select few on this occasion. Now, this NPL communication and the measures we put forward, they basically, as I said, focus on the environment. So they relate to the development of a secondary market for NPLs, so via enhanced data availability and comparability of data as well, the establishment of an EU network of asset management companies, and improvements in the restructuring, insolvency, and debt recovery frameworks. But I think if I was to describe this communication more generally, I would say the main objective was to send a reminder to member states, a reminder not to make the same mistake as we made in the last crisis, and to address the accumulation of NPLs earlier rather than later. We also need to keep in mind that the challenge of rising NPL ratios from COVID will come on top of other structural challenges already facing EU banks. Profitability in the sector is low, there's excess capacity, and competition, notably from new fintech operations, is pretty stiff. So all of these challenges then must also be managed in an environment of durably low interest rates. So even if the banks are sufficiently capitalized to manage the aftershock of the COVID crisis, there are clearly important challenges ahead. And banks will need to adjust so as to increase efficiency, lower their costs, and exploit the opportunities and manage the challenges of moving to the digitalization age. But I think policymakers also have an obligation to provide a supportive environment for this adjustment process. And part of that supportive environment, in my view, is of course the banking union. Now, at the most fundamental level, of course, policymakers must ensure that the economic recovery post-COVID is as strong, sustainable, and cohesive as possible. And to this end, the support measures must be withdrawn in a manner that avoids cliff edge effects, and any new investment must be targeted to maximize growth and be accompanied by reforms that enhance productivity. But as I said, these steps, these more indirect steps, must be accompanied by direct support to the adjustment process in the EU banking sector, and these steps include completing the banking union. So if I can move now to what's going on with banking union, I said earlier that progress in completing the banking union had slowed sharply since the early achievements of putting in place a single supervisory and resolution framework. And these were fairly spectacular achievements given the time in which, the 5-year time span in which we did it. But the reality is we still have some way to go. 4 main work streams have been identified, and they've been mentioned already by Pia. These are the reinforcement of bank crisis management framework, the creation of a common deposit insurance scheme, facilitating cross-border integration or the home host issue, as has been mentioned, and then changes in the regulatory treatment of bank exposures to sovereigns. And I'll briefly touch on all 4 of these work streams in the remainder of my time. So let me start with the reinforcement of the crisis management framework. Now here the Commission is preparing a review of the crisis management and deposit insurance framework, as we're calling it. We believe the time is ripe to evaluate the functioning of this framework and to address some of the weaknesses that have been identified during its first years of application. A comprehensive framework for resolution or liquidation of a failing bank has been established in the BRRD and the DGSD. So this is the Bank Recovery and Resolution Directive and the Deposit Guarantee Scheme Directive. But to be honest, this framework has been rarely used, or has been used in a manner that it was not originally intended to be used. So the objective has to be to allow for a more extensive and appropriate use of the framework by ensuring that it can cater for the full population of EU banks, covering all business models and ensuring a proportionate but still effective treatment of small and medium-sized banks. To this end, we need to look at several key elements of the crisis management framework. Now, without going into too much detail, because I don't have too much time today, these elements of the framework would include the scope and application of the public interest assessment, or PIA as it is called, and how we apply it. That's the decision that determines whether a bank is resolved or left to liquidation. A second issue is the availability of effective liquidation procedures, including administrative procedures in addition to judicial procedures across all member states. A third area is access to external financial support to finance resolution or liquidation. And then lastly, the interactions between the resolution and liquidation framework and the EU state aid rules. In looking at all these areas, of course, the overarching objective of maintaining financial stability and protecting taxpayers must not be compromised. But within that constraint, within that overall constraint, we must explore ways to ensure that the crisis management framework and the deposit insurance framework deliver the most effective outcomes in avoiding unnecessary value destruction. And as has been said, we have launched a public consultation on this. And depending on the outcome of that, we propose to put a proposal on the table by the end of this year. Now, a second work stream in banking union relates to a common or European deposit insurance scheme. As has been mentioned by Pia, the Commission adopted a proposal on EDIS back in 2015, and our ambition for EDIS has not changed. So we see, in our view, the banking union can only be complete when EDIS is also in place and fully functional. That is, covering liquidity needs, but also taking losses in episodes of bank failures. In this way, all depositors in the banking union will have equal cover, irrespective of their bank and irrespective of their geographical location. And this, of course, is one key characteristic of a single jurisdiction, the single jurisdiction we want banking union to be. At the same time, we have to recognize that a first phase of liquidity support from EDIS will already greatly strengthen depositor safety nets and by extension underpin financial stability across the banking union. In addition, the idea of the so-called hybrid EDIS based on the coexistence of national DGSs with the common central fund has also emerged as a possible way forward following extensive discussions through the last 2 years. Now, such a hybrid model could pave the way for the gradual evolution from a first phase of liquidity support towards a more ambitious loss sharing phase once conditionality safeguards, which we have not yet identified, are properly fulfilled. So we see some avenues for progress in EDIS as well. A third work stream is facilitating cross-border integration of EU banks. Here, potential measures to enhance integration are also on the table as part of the banking union discussions. These measures range from stock takes of obstacles to integration and up to shorter, smaller steps to operationalize existing provisions in the framework, for example, liquidity waivers, even then to longer term measures, new measures, such as cross-border capital waivers. Importantly here, any measures that impact on the so-called home-host balance must be accompanied by credible and enforceable safeguards for the host member states. These safeguards are necessary to ensure the right balance between exploiting the efficiencies in cross-border integration, while at the same time safeguarding financial stability at the national level. The fourth work stream is reform of the regulatory treatment of sovereign exposures, and needless to say, this remains, I think Pia has mentioned it, a highly controversial subject. It's controversial not only within the EU, but also at the global level. The discussion at the global level, which took place in the Basel Committee on Banking Supervision, has not resulted in any changes in the international prudential standards. So there has been no agreement there. And at the EU level, similarly, member states have very different views on the potential merits of such a reform. Some member states consider a reform like this would discourage banks from holding concentrated sovereign exposures, and they see this as an essential component of risk reduction strategies in the banking union. These member states seek to reform the regulatory treatment of bank sovereign exposures to reduce the so-called doom loop between banks and sovereigns. Other member states consider that such reform would be a source of destabilization of sovereign bond markets that will increase their funding costs. And then you have another group of member states who seem relatively agnostic on the whole issue. Now, in order to support this discussion, this difficult discussion, the Commission is working very closely with the European Banking Authority to analyse the role of sovereign debt in the financial system and the impact that regulatory change may have on banks, on financial markets, and indeed on sovereigns. This analysis, I think, will help us to understand better the pros and cons of any potential change to the regulatory treatment of sovereign exposures. Our intention is to continue to support this debate, both among member states, but also the European Parliament. And in any event, the reflections on the regulatory treatment of sovereign exposures should continue to be part of this wider debate, this wider approach to work on completing the banking union. Let me now just finish, because I think I've probably gone beyond my time. I believe that banking union can be an important contributor to a strong and sustainable recovery from the COVID-19 crisis. In the longer term, it will also enhance the resilience of the economic and monetary union. And for this reason, I think we need to show that we can make progress and work towards common goals to the benefit of the banking union. As the saying goes, we are halfway across a sometimes fast-flowing river, and that's never an entirely comfortable place to be. In December, the heads of state and government of the euro area invited the Eurogroup to bring forward a work plan, as Pia has mentioned, on completing the banking union. This is a major task, but it does reflect the importance, the political importance that is now being attached to the file. We in the Commission, of course, remain very supportive of attempts to find an agreement on a broad work plan. Of course, we understand that the topics to be tackled remain politically very sensitive and will require important compromises on all sides if progress is to be made. But I'm relatively optimistic, even if we have some pretty hard work ahead. Maybe I'll stop there, Pia, and hand the floor back to you. Thank you very much.
Thank you very much, John, and we all agree that this is an issue of great political importance and a really big task for the European Commission, and we are all anxiously waiting for the work plan in June. I will now give the floor to our next speaker, and before giving the floor to him, I will remind you that you can pose questions in chat of this Teams format, or you can also orally ask questions after the three speakers have all spoken. But the next speaker will be Mr. Eero Heinäluoma, who is, of course, an honourable member of the European Parliament. Mr. Heinäluoma represents the Progressive Alliance of Socialists and Democrats in the European Parliament and is actually also a treasurer of this big group. Mr. Heinäluoma is a former party leader of European Finnish Social Democrats and Finnish Minister of Finance. He has also served as a Speaker of the Finnish Parliament. Currently, Mr. Heinäluoma works in the Economic and Monetary Affairs Committee of the European Parliament and also in Budgets Committee, and he also participates in the work of the Extra Committee on Tax Matters. So floor is yours, Eero, and I hope you can give us insight what happens in the European Parliament on these themes.
Thank you, Piia-Noora, and thank you for the possibility to be here, and thank you for the possibility to also to speak here. I have to congratulate you for the excellent timing of this roundtable, and it's really happening in such a moment that a lot of things around this big team is going to make progress. There are three main reasons that this is really happening in an important and timely way. Firstly, we are still in the depth of a health and economic crisis affecting our economies and also our banks. The public taps have been opened to support our economies and banks, and rightly so. Secondly, we have experienced the biggest EU support operation since history with the adaptation of the next generation EU. And thirdly, as we know, the European Commission will present its proposals for reform of some targeted pieces of banking legislation in the end of this year. And the Commission will organize a conference tomorrow on its crisis management review. So I sincerely hope that some messages of today could inspire the further reflections. A discussion about the completion of the banking union is a necessity for the success of the European Union. And as you know, there is a very wide support for the completion of the banking union in the Parliament. And at the same time, we have to acknowledge, as always, the devil is in the details. I suppose that an overwhelming majority agrees on the destination and the benefits of the idea of the banking union for the whole EU economy. However, the views around the safety of the journey to get there still differ to a certain extent. From an economical and financial stability perspective, the gains of a banking union started since the financial crisis of 2008 has ensured that the banking sector in the euro area and the wider EU is more stable, safe and reliable. And in this respect, we have to commend the Commission for having made important legislative proposals over the last 13 years to achieve a more integrated banking sector. And indeed, we now have EU banking supervision, much better capitalized banks, and a resolution system for failing banks. Really important things. And work is ongoing on the third missing pillar, as we heard, a European deposit insurance scheme. In this respect, it's worth to underline the commitment taken by the Eurogroup and as we heard in the end of last year, to make a route plan towards June 2021. However, as said, the views around the safety of the journey differ to a certain extent, and this can be also seen in the discussions inside the Parliament and in the Econ Committee. To me, it's hard to talk about the sustainable banking union in isolation, separated from the real economy. Indeed, banking union should not be a goal on its own, but an important tool to help the EU economy thrive and grow. Looking from this angle towards the banking union project, I believe it's fair to say that despite the important steps which are mentioned before, there is still a lot to do to make sure that the banking sector everywhere in the European Union functions according to the same rules and capabilities. And clearly, there is a job for the sector as well as for politicians and regulators to do. Firstly, it's critical that we acknowledge that there are key problems in the European Union banking sector, which was mentioned by the Director General Berrigan also here. It's important that we are ready to acknowledge the problems and we don't look away from these problems. In this respect, when it points towards key structural weakness in the European banking sector that were evident even before the crisis hit. European bank valuations have been depressed by very low profitability caused by excess capacity, limited revenue diversification and low cost efficiency. We know that this is not the case in all the banks. We know the situation is quite much better, for example, in Finnish banks. Although the banks have stepped up cost-cutting efforts in the wake of the pandemic, I suppose they need to push even harder for greater cost efficiency also in the future, and in particular when we are coming to a more digital area. Secondly, there is a key role for policymakers to set a legal framework which creates certainty and which is apt for the goals to achieve, namely financial stability, protection of taxpayer money and continuous support of the economy. It's important that the discussion goes beyond the buzzwords, risk sharing versus risk reduction, and looks into the facts. And this leads to the question which type of banking landscape do we want in the future. In this respect, and to make an important step towards a sustainable banking union, I believe it's important that EU-komission reforms keep always the basic principle in mind, a comprehensive and effective implementation of the bail-in principle so that the costs for taxpayers could be minimized in the case of bank crisis. Indeed, protecting taxpayers' money should be always the key point when dealing with failing banks. I realize the complexity of the interaction of the EU resolution rules, resolution funds, and national insolvency rules and the public interest assessment, which have to be all made. But I believe that in the long term, it's better that unviable banks are not kept alive artificially with taxpayers' money. In this context, I read carefully the easy communication around crisis management and deposit insurance. In my view, a better alignment of the existing rules, for example, the crisis management rules and the state aid rules, could be an important step forwards. Indeed, the question is whether the amount of state aid which has been approved to support some banks over the last years has always been the best investment. I hope the Commission will look into this in the coming months and also proposes a better alignment between the resolution and state aid rules. In this respect, I'm not fully convinced of an absolute need for a separate resolution regime for smaller banks, as according to the Commission, they could have more difficulties in raising money. Whilst this could be a reality, and with all respect for the diversity of the EU banking landscape, at some point the long-term viability of some business models should be questioned as well. To protect the depositors of failing banks, I believe the European Deposit Insurance Scheme could be a helpful tool. Of course, if we are all members of the same club, we must have the same rules, and we can also make progress together. I fully agree, in a club you can also share the risks. However, a club will not win that often and make progress if not everyone is transparent about its condition and about the risks it brings to the club. Therefore, everything starts with full transparency around underlying risks. This knowledge will comfort all the members, and indeed a lack of transparency around the risks brings the whole club in danger. Therefore, progress towards a common deposit insurance requires a clear roadmap where risk-reducing measures are agreed on, the credibility of the agreed crisis-solving system is restored, and the bank regulation is reformed in order to enable sovereign debt restructurings. Further, there is an absolute need for more clarity around the state of the national deposit guarantee schemes and their funding, as well as the health of some banks. I do acknowledge that important steps have been taken over the last years to reduce risks with rules around non-performing loans and the building up of minimum requirements for own funds and eligible liabilities. Nonetheless, in Portugal, against the impact of the actual crisis, full transparency will be vital to take further steps towards an EDIS. Money from such an EDIS should also be used, in my view, to support depositors, not keeping failing banks alive. And yes, it's hard to speak on the one hand about breaking the doom loop between sovereign and banks, and on the other hand, to refuse to talk about the risk weight of sovereign debt. And I suppose this is probably the elephant in the room. I'm fully aware that this is a very sensitive issue, but we cannot stay longer silent on also this. I would say that public bonds represent to a large extent the risks of the underlying economy, and we all agree that the economic health of the different member states differ. As such, this is not a problem, certainly not today, when the interest rates are as low as they are. However, we can't do as if these economics exist. A sustainable banking union is therefore a union where differences around sovereign debt risks are recognized and also probably reflected in the banking balances. Again, I'm fully aware that the discussion around the risk weight is a very sensitive discussion, but to get EU-wide political backing, it's critical that the journey towards a sustainable banking union is fair and balanced, and that every member state and every type of bank can rely that their voices and interests are heard. 13 years after the financial crisis, we cannot afford an attitude that there are too big to fail. Furthermore, a long-term sustainable banking union can only be organized if there is a full clarity around the origins of financial resources. Therefore, I once more call upon the Commission to come forward with an ambitious AML reform in the coming months. To conclude, a complete banking union is useful for all of us, our savers, our taxpayers, our banks, our economies. But a new type of banking union is needed. I believe today we are at a critical moment against the background of the biggest EU supporting mechanism which has been set in motion. This supporting program could become a game changer, and it ought to become a game changer for the European economy, and in this way critical for a sustainable banking union also. A banking union where there is full transparency around risk profiles of banks, where rules are effectively implemented to protect taxpayers' money, and where unviable banks can be orderly resolved. In this respect, we also really count on the capitals to come forward with ambitious reform programs and upon the Commission to assess these plans carefully. This is a once-in-a-lifetime possibility to get the economic engine in the EU to restart. So let's not miss out of it. Once more, I would like to thank the Finance Finland for organizing this event. Unfortunately, I have the tax committee meeting just in a couple of minutes, so it means that I can be only present in the beginning of the roundtable, but I'm ready to continue our cooperation also in the future, and I hope you all a very good and lively debate in this roundtable meeting. Thank you.
Thank you, Eero. Thank you for your valuable words and your presence in this event. And we know that you are busy with your parliamentary work and must be soon in the tax committee meeting. And I have already asked you before the event that if there are questions to you, I can refer to you and I can send them on email, and maybe you can come back to the questions later after the committee. Thank you, Eero. And I will now present the third speaker. Third keynote will be coming from the Mrs. Leena Mörttinen, who is Permanent Undersecretary of International and Financial Market Affairs at the Ministry of Finance in Finland. And Leena is a doctor on social sciences and finances, and she is currently serving as also as a Finnish member in the Finance Market Committee of the European Union, in the Economic and Financial Committee of the European Union. And before her career as a civil servant, she has worked as a CEO of Family Business Network in Finland and served in different managerial and expert positions, for example, at the Confederation of Finnish Industries, in the Nordea Bank and Bank of Finland, and also a while ago at the European Central Bank. We are very delighted that you are here, Leena, and the floor is yours.
Thank you, Piia-Noora, and hello everybody. I hope you hear me. It took a while to find the right buttons, but pleased to be here, and many thanks for inviting me to share our views on this particularly important topic at this crucial time when it is being developed further. Just short reflection first on the previous speakers. I think the the point raised by Eero Heinäluoma is very relevant. I mean, this is all about the real economy. This is what we should be talking about. We should talk about the efficient allocation of capital, particularly at this juncture where we are still in the middle of the crisis and have to wonder how we can get on a recovery path that truly creates the sort of strong European economy, which will then, of course, unavoidably also, if we succeed in this, strengthen, for example, the international role of the euro, which is another topic that is being discussed and where the banking union is also referred to. It is important indeed to complete the banking union, but not just on any principles. The principles do matter because they link to the whole question whether we have efficiency that we need in the economy to grow. And I have to say, Jean mentioned and Eero mentioned as well, the inefficiency and low profitability of the banking sector. Now one has to think about it very carefully of the root causes that have resulted in this. And I really do argue that the fact that we haven't been able to respect the rules that we've established so far as comes to the bail-in regime are truly a part of the problem. Because if there is sort of a feel of getting away with it and not having to carry the brunt of the risks taken, that somebody bails you out, this constructive ambiguity world where we have been living in, it will definitely create inefficiencies, the low profitability and hinder banks also from looking for mergers elsewhere because their owners will accept this and the governments support that unavoidably because the critical infrastructure has to be there. So I think it is of key importance to get the banking union to function as it should. And this is the view of the government very much at this juncture as well. Our government recently adopted the policy paper on EU and the policy paper provides the overarching principles, including the banking union as regards the banking union. And the government reaffirmed the importance of the banking union and the need to strengthen the capital markets union as well to complete that or take it further. And these are key to strengthen the EMU. And the banking union and the CMU are needed to sever the bank sovereign nexus, which we think is very important. And of course, at this particular time where we are at, it probably has grown. Finland's basic premises is that the banking union should be based on the no bailout principle. So bail-in is an effective way, part of the banking union, and we are, however, it has to be implemented properly. And it has to produce the value added in respect of the final bailout, all sorts of banks in all sorts of crisis situations. It does mean, however, that the sort of market discipline is there and the private sector takes care of its own share of the risk that they actually have generated. Towards EDIS requires a roadmap and we fully agree on that. There should be the risk reducing measures adopted now that although we were in such a great path before the COVID-19 crisis, we have probably come to a worse situation. So we need to make cleaned up and the efficiency of the system is somehow reaffirmed. As Jean mentioned earlier, it is very important. It is the role of the national supervisors, of course, the ECB as well, but also the national authorities in general to act on this now. The credibility of the crisis management framework needs to be restored. And finally, for us, it is very important that the sovereign debt restructurings are also there as part of this whole work plan, not just discussed or referred to briefly and said that this cannot be done. It is important to understand that the sovereign risk is one of the key systemic risks that has to be priced properly. I know it's painful, and of course, implementing it in this crisis situation doesn't make sense, but unavoidably in the future, in order for the markets to price things correctly, which we look them to do in order to be able to respect a bail-in regime, they will have to do it. They will also have to price this risk because there is a covariance between the risks, and risk pricing is in the, for the end customer, has to include everything in between. Liquidity risk and sovereign risk are key to price correctly. So, I mean, overall, the stance of the government is positive on EDIS, but it really requires the right conditions and right steps to be taken. And it is somewhat challenging at this point of time to start discussing a sort of when we get to the political negotiations on EDIS, when it seems that since we dropped away from the path where we were before COVID crisis, we are in a new situation where the crisis creates new challenges. We have the most likely a worsening condition of banks' balance sheet, and at the same time we open sort of all the key packages where the principles that we have previously said that we honor are actually written in. We don't know where we end up. There's a discussion also, as has been mentioned, on a new resolution regime for small and medium-sized banks, but we find that extremely difficult to really understand what that would entail and whether EDIS would be part of how the EDIS would be part of the whole package until we see what is proposed here. So, I mean, for us, it is clear that the marching order is there for first to understand what the crisis management and deposit insurance proposal from the Commission will entail. And after that, we understand and have an understanding, common understanding of what sort of principles that will be based in, and particularly that the bail-in is there still as a key principle. We can start looking forward to other things. We have to have clarity on the regulatory treatment of the sovereign exposure, exactly for the reason that it is really difficult to believe that we would actually be able to put together a banking union that would support the real economic growth in a sense that we need going further. So I mean, I think we really do need to work on that. That should be a key part, not just a discussion, but a key part of it. And then finally, when we see what we have together in terms of these, we can then start agreeing on EDIS. But that's basically where we stand at the moment. But I mean, we fully agree that this is the most important discussion that we have to have some sort of an idea how we progress. But the work plan is a bit of ambitious thing to do. If we start with the EDIS, I think we should start from where we are discussing now, reopening the lines that we have and seeing that we actually stick to the guns. And it's suffice to say that for us, one of the reasons why the crisis management framework hasn't been quite applied as it should have been, and the banks have not really gone through the processes, the ones that have been in crisis, as they should, with the private sector carrying as part of the responsibility, is the 2013 state aid rule exception, the banking communication, which has resulted in sort of creating this alternate universe where you actually don't have to follow the rules. And that's why the feeling that the crisis management framework doesn't work is sort of spreading now. And we are rather unhappy about the idea that there is something fundamentally wrong about the package. I think the problem is with the state aid exception, and that's why these exceptional circumstances where we are now, although they are completely justified for the corona crisis, that we can overcome it, we should first try to exit from these exceptional tools.
For questions, if there are any, you can ask questions in oral format by raising your hand. Any participants who would like to take the floor we have time for a couple of questions before moving to our next presentation. This is a Wednesday morning, so it might be that we are still a little bit reluctant to take the floor. I can't see any hands raised. And I'm not actually sure if Mr. Heinäluoma has already had to go. I think he is not yet, not anymore present in the event. So maybe I will ask from our first speaker, Mr. Berrigan, that now you have heard the presentations from the European Parliament and also from Ministry of Finance. Would you have some comments you would like to make at this stage before I give the floor to Finance Finland representative to tell us about the topics. So, Mr. Berrigan, do you want to comment on the other keynotes?
Well, thank you very much, Piia-Noora. Yeah, maybe just a few comments. I've not heard anything from Leena or from the previous speakers that upsets me or that is different from what I think the general debate is about here. What I will say is that the devil really is in the detail, because nobody, I think, is questioning the principles. And as I said in my opening remarks, we want to preserve the two key principles of the crisis management reform, for example, which is, of course, to protect taxpayers. But let's not forget there's another principle, which is to preserve financial stability. And there is a presumption that in all cases, these two principles are coherent. But there are examples where they may not be. That's one point to make. But the real problem is not that we want to observe these principles. I don't think any government wants to spend public money on banks. It's not necessarily a vote winner, let's be clear. But I think the problem is the practical implementation of those principles. So when it comes down to the details of implementing these principles, it is clear that those governments, or at least most of those governments that have been asked the question, do not feel sufficiently comfortable or sufficiently confident in the framework to actually apply it, because they worry that in applying one of those principles, i.e. to protect the taxpayer, they may undermine the other principle, which is to preserve financial stability. So we come at this reform of the crisis management framework not to tear up the books and change the principles, but in fact to make sure those principles can be applied. And so clearly there's something in the framework that in some places is creating, at least in the perception of those who are asked to use it, a tension between these two fundamental principles of preserving financial stability and protecting taxpayers. And that's what we want to do. We want to look at the framework to see why this tension exists. It seems to exist in a particular place. So it's the usual problem. We have a framework which has not been tested yet, but seems to know how to manage a too big to fail bank, so a very large bank. And we have a judicial process which can handle very small banks. But it's these little, not so small, medium-sized banks in the middle where these tensions seem to arise. And that's why we're looking at the application of this framework to those banks. So do we need to apply resolution, perhaps the framework, further down? Or is there a need for a special regime for these mid-sized banks with particular problems, which, not because I say so, but because the evidence shows that those governments who are confronted with using public money feel the need to use it because they're worried about financial stability. So we have to reconcile these two things. So on the crisis management, on EDIS, well, it's a little bit about the same thing. There comes a moment when you have to remember that we're all part of a system. And there are relatively strong and relatively weak members of the system. But as part of the system, we are all exposed to those risks that affect the system. We just have to look at Greece back in 2010, one of the rather smaller parts of the system, but because it was in trouble, it almost derailed the euro area as a whole. So even if system, and you have absolutely every right to expect of everybody else to be as committed to the right principles and the right disciplines and the right transparency, the reality is, so long as you have relatively weak elements of the system, even if you are strong, you are exposed to risks. And it can be intelligent, it can be the right thing to do to help the weaker ones to manage those risks because it's in your own interest. So if you're waiting, and if your idea is to wait until all of those other risks are eliminated, so everybody is at the same level of super strength, that's one possible approach, but you're going to have a long period when not just those countries, but you also as part of the system will be at risk. So it's not a gout. I fully agree with Leena when she says that there are requirements, and I think that of transparency as a requirement for other people to manage those risks, and that's absolutely fine. But we have to be careful that we don't set the bar at such a level that we never get there. I mean, if EDIS was already in place because all NPLs had been reduced to 2.5% net, as we required, and now we were hit by the COVID NPL wave, would we be talking about dismantling EDIS now? No. So you cannot make a permanently low level of NPLs at some level a permanent condition for ever launching EDIS. The arrangement, the agreement was that those countries who had built up NPLs in the previous crisis, i.e. prior to the SSM, prior to the SRM, these legacy losses should be eliminated, should be removed. They have in large part been removed. That is why we're able to go forward with the backstop. Now we have a new wave of NPLs, which will come to all member states, by the way, not just to a few member states. Is this to be another condition? I would think this would be probably an unwise thing to do in my own thinking. That's a recipe for never actually moving forward at all. And lastly, on RTSE, I mean, I fully agree that RTSE must be on the agenda at some point. Sorry, regulatory treatment of sovereigns. I'm using acronyms. I apologize. The regulatory treatment of sovereigns needs to be on the agenda. But this is another case of balance, because we will need to understand that in trying to achieve a long-term objective of financial stability, I tend to agree that the treatment of sovereigns is part of a long-term effort to establish stability in the monetary union. But in aiming for that, we don't create the very risk we're trying to prevent in the short term. So this one has to be managed very carefully, both over time, but also in terms of what we do, because there are ways in which we can implement it which will enhance stability, but there are equally ways in which we can implement it that will actually create the problem we're setting out to avoid. So I've covered three of them. Nobody seems to have mentioned much about the cross-border integration. I just will say, look, it was said that the objective of banking union cannot be banking union itself, and I fully agree with that. The objective of banking union is to create an integrated, diversified banking system, where you will have a coexistence of national banks and cross-border banks with varying business models. This is what Europe sees as the definition of a safe, sustainable banking sector. The fact of the matter is we don't have that cross-border element. And if we want to compete in the world, if we want to have a capital markets union that is single, a cross-border capital market, we will have to have cross-border banks the way in which they have in other parts of the world. If we don't have cross-border banks, building a capital market will be much more difficult. So everything is linked to everything else. This doesn't get an awful lot of attention, but it needs to get a bit more attention, I think. Thanks.
Thank you. I still remember what you said in your last phrase about the banking union, that it is not a goal in itself, but more a tool to create this flourishing capital market, flourishing banking market in Europe. I still remember the time when it was only the European Parliament who was in favor of creating a single supervisor in Europe. Commission then further on started to back the European Parliament, but these ideas actually came long before the financial crisis of 2008. From the European Parliament, and I hope that we don't need another crisis really to complete the banking union. But what you said also about the level of risk reduction, we can't go to zero. There's no such future that the NPLs level would be zero or even 2.5 in the longer term. So this is not an issue. But where we have the difference of view seems to be that we think that the liquidity support would be able to help those weaker links of the system, and that we don't really need the absolute final loss sharing by the system, which you mentioned that it is part of the Commission vision on European EDIS. But Leena Mörttinen has asked for the floor, so I will give the floor to Leena, and there are also some comments in the chat box, so you can visit and see what people have in mind. But Leena.
Thank you, Piia-Noora. Yeah, it's we've had this discussion with Jean for quite a while now, and of course I'll keep on stressing that the banking union was not created for cleaning up the old mess, as you mentioned as well, but surely its finalization, it is very unfortunate if we have to try to do it in the middle of the corona crisis. It is clear that we have to have exceptional measures accepted, but those are surely national measures at the moment. This is a tool for steady state where we know where we are at the starting point. We should have low enough level and a level playing field, common rules followed, and we haven't done it so far. And this is our concern, that this is not a level playing field. This is distorting the system. It is creating inefficiencies that cannot be accepted. Now, of course, as we progress, and if there is need to create a new sort of a partial framework for certain types of banks, then it will have an impact of how EDIS will be implemented. So for us, there is no hybrid model. There is an end model that could very well have the sort of a national and then the centralized fund type of a model, but everything affects everything. So, I mean, these bits and pieces are connected, and there has to be order of how we come to a conclusion on this, and keep on stressing the fact that this should really be for the benefit of the real economy, that we get an efficient allocation of capital, that we have efficient banks and capital markets in general that take on the risk, carry it, and bear the losses rather than the taxpayer. So I understand that in these conditions, if we would start implementing and finalizing banking union in the middle of the crisis, it probably is so that the financial stability and the taxpayer interest are contradicting each other. But if we actually implement it in a steady state where we reduce the risk also from this crisis and cleaned up the banks, then surely that would not be the case, because the financial stability would be upheld by the fact that there is no taxpayer money. There is the private sector really doing what it should. So the bail-in being respected. Thanks.
Thank you, Leena. This is a very interesting discussion, and I hope that it continues. But I will now give the floor to representative of Finance Finland, who will be Mr. Veli-Matti Mattila, who is a director and chief economist of Finance Finland, and he will give the comments of the Finnish financial sector on this topic. So I hope we can get Veli-Matti's slides to be shown to everyone. But you can also continue putting questions to chat and raising your hand, because later on we will have more time for discussion. This is a round table in the end. So Veli-Matti, floor is yours.
Thank you. And thank you for the speakers for very interesting presentations. I will shortly comment them from the point of view of the Finnish financial sector. Well, I have few slides to help you follow my presentation. I wonder whether you already see them. If the assistant could roll them a little bit further. So first, about the starting point, the economic crisis that we are currently living created it's very deep, and there will be lots of non-performing loans in banks in the euro area and EU. But there are differences between countries and banks. In some countries, the recession has been deeper, and the impact on banks as a result will be larger in terms of credit losses and NPLs. This means that the competition of the banking union will be more difficult than what was the situation a year ago when the pandemic started. This means that the risk reduction process needs to be restarted, as it has been said in this roundtable earlier. And it is evident that it will take long and be costly. As far as the Finnish banks are concerned, they were in good condition when the pandemic started, and they have withstood the crisis well. Just yesterday, the supervisory authority, the FinFSA, said that the Finnish banking sector situation is strong, and its capital position and possibilities to grant credits are better than the European average. Next slide, please. There are several issues on the table when we talk about completing the banking union, as we have heard today. One of them is the crisis management framework. The other is EDIS. These two are intertwined, as we have heard. For instance, it has been proposed to create an EU bank liquidation regime for deposit financed small and medium-sized banks, and to use deposit guarantee schemes to finance balance sheet transfers, for instance. In addition, it has been suggested that the coverage of deposit insurance is enlarged to contain other liabilities than just cover deposits. When we think about the reform of the crisis management and deposit insurance framework, there are some general guiding principles that we should be using as a starting point in the design of the system. These may sound self-evident or even simplistic. However, in practice, it is not at all certain that they are followed currently. First, the balance sheet of a failing bank should be properly valued. This is a precondition for timely crisis management measures for knowing whether the bank is failing or likely to fail. Secondly, the amount of capital must reflect correctly the risks of the bank, including sovereign risk. Thirdly, MREL requirements must be fulfilled in the set timetable. This is a precondition for bail-in to be possible in the first place. And finally, crisis management should be started in a timely manner and be implemented efficiently. This should apply both in resolution and normal insolvency proceedings in order to preserve the value of banks' assets. There should be an obligation for the resolution authority to act timely. Taken together, these principles have a clear implication for the deposit guarantee system. When the principles are followed, it ensures that there are enough funds in the estate of the failed bank to cover at least the insured deposits. As a result, there should be no final losses to the deposit guarantee scheme, whether it is a national or EDIS, and whether it is used for financing payouts, balance sheet transfers, or participation in resolution. Naturally, this holds ex ante. Ex post, it is still possible that some losses arise, but the probability and the amount of these losses should be minimized beforehand. Next slide, please. What about EDIS? The recent debate has centered around a hybrid model, as we have heard, where there is a central fund working together with national systems. As such, the Finnish banking sector doesn't object a hybrid EDIS if it's designed properly and if certain preconditions are met. In general, we see that the current system based on national deposit guarantee schemes is working well in the EU, and there is no pressing need for establishing an EDIS. But if EDIS is established, it should be designed in a way that the objective I just mentioned is attained. There should be no final losses to the system. This implies that EDIS is only needed for liquidity provision in the banking union, to lend liquidity to be used by national system if its resources are depleted. This liquidity support should be given as loans and paid back in agreed timetable. In general, the task of the deposit guarantee scheme, whether it's national or EDIS, is only to protect insured depositors. The funds should not be used for other purposes, for instance, to cover other liabilities of failing bank. And if liquidity is provided, the amount of loans should be capped, and these loans should receive a super priority status with respect to other claims to the estate of the failing bank. This ensures that there should be no losses to the system except in very specific circumstances. And these losses should be covered by the national DGS or the failed bank. If there is a need to have alternative ways to handle bank liquidation, for instance, transfer of deposits and corresponding amount of assets of the failing bank to another institution, the deposit guarantee scheme could give liquidity support in the form of loan. But also in this case, ultimate losses should be avoided to the system. Most of the funds in the possible EDIS system should be kept in national level, as this underlines the national responsibility for banks and maintains enough room for maneuver on national level. Liquidity support to a national system could be provided first from the central fund and secondly from other national systems. And next slide, please. Finally, a few words about the preconditions for establishing an EDIS. As I mentioned at the beginning, the pandemic will increase the stock of NPLs and weaken the financial situation of many banks. This calls for an asset quality review of these banks, how their balance sheets have been valued and whether there is enough capital to cover risks. In addition, there are still deficiencies in the regulatory framework. One of them is the prudential treatment of sovereign exposures, which have been mentioned several times during this roundtable. When the Basel Committee published its discussion paper more than 3 years ago, the 3 Nordic banking associations, Finland, Sweden and Denmark, drafted a joint response to the committee. The key points in the response were sovereign exposures should be subject to a standardized approach under Pillar 1. Calibration should be risk sensitive and granular, which means that it should reflect the underlying risk of each asset. And finally, sovereign assets should not be favored relative to other assets. If or when the Commission delivers its proposal, we will reassess our position naturally. I must emphasize that this is one of the key issues for us in the competition of the banking union. We do understand the political realities, that there is also an international dimension here that needs to be taken into account. But this question must be tackled in one way or another if we want to finalize the banking union, including establishing an EDIS. Thank you.
Thank you, Veli-Matti. Are there now questions? I can see that there is one question actually in the chat box, so I will read it. Mr. Privitera asks, any ill-timed risk reduction process could jeopardize the soft landing Europe needs. As Mr. Berrigan pointed out, standing still in the middle of a swelling river is a risky proposition. Unless red lines of banking union are softened on all sides, there is a risk of falling back rather than slowly moving forward. Very interesting proposals from Finance Finland. So this was not a question, but more a comment. But maybe Mr. Privitera, you would like to also pose a question.
Thank you very much. I think it's a very interesting debate, and I think especially the last proposals made by Finance Finland, in a way, it seems that we have to find a way to break the deadlock of years of discussion on banking union along sort of familiar lines, and the question is whether the current discussions on the crisis management and interlinkage with EDIS or a hybrid EDIS are the way to break that deadlock, or whether the participants to the panel discussion see any other chance of moving forward in a slightly more decisive way, given all the suspicions that seem to be still present among member states on this very important issue.
Thank you, Mr. Privitera. Are there any further questions, or would the keynote speakers want to reflect on some of the proposals made by Veli-Matti Mattila or Mr. Privitera? Yes.
Okay, maybe I will.
You can, Mr. Berrigan, you are.
Okay, no, Leena, please go ahead before me.
Okay, Leena first. Women first. Leena, floor is yours.
So sorry to be so quick. I actually quite prefer to hear Sean go first, but I can of course react to Mr. Privitera's comment about, exactly right. We have to somehow move forward. I don't think we disagree on moving forward. I think we have a bit of a different view of what are the bits and pieces that have to first be on the table before we can progress on the EDIS, because it affects the end result. But I think we have a full agreement on this, and it's also something that Finland has stated for quite a while already, that we are committed to having EDIS completed as well as part of the banking union, and in that way also the full banking union. But it really matters with reflecting on the financial stability and protecting taxpayers. Those two, that's a principle that should also be respected in the banking union. Those should never contradict. it should be the same thing. And it's an interesting, if you try to complete and have political agreements on things where you sort of question whether financial stability and taxpayer interest could be met at the same time, then there is something definitely wrong. And I'm afraid that we would cause permanent harm to the union if we do it in this manner. So that's why, I mean, we are keen on continuing to discussing, but also understanding what the bits and pieces. Thanks.
Thank you, Leena. And Mr. Berrigan.
Thanks a lot. Well, maybe I'll just come back on one point that Leena made last time, which I always have to make, which is the reference to the steady state. This is a concept we use all the time. I have to say I use it myself all the time, but it's a theoretical concept. It's like the concept of equilibrium. I mean, those of us who know economics will know the debate between whether there is a single long-term equilibrium or whether we're always in some kind of equilibrium. It's just a matter of where you are. And there probably is no sort of unique steady state here. And if it is, it's not steady for very long. So it's a good theoretical construct to explain, in theoretical terms where you want to go. But the notion that that somehow you'll reach some steady state and you're in it, and that's exactly the moment that you're going to move, A, is not possible, I think, in reality, and B, to align a political process around such a thing is impossible, given that our political process takes years. So I use the steady state construct, and I understand it as a sort of frame for generally showing you where you need to go. But there will be a point where you have to jump. And we had this discussion around the time of the euro back in, those of us who are old enough to be around in those days, exactly the same discussion. I mean, is there this perfect moment when it's the right moment to launch the euro, or do you have to get as close as you can and then launch it? So I agree on the idea. I mean, I'm the one who promoted the steady state banking union concept myself, but it is a theoretical construct. It is a way of organizing your thinking, but creating as a practical condition for moving at all, I think is probably a condition for never moving at all. Okay. Now, on some of the points made on the crisis management framework by Finance Finland, I had no problem with any of these principles. I hope I reflect them in my own remarks. The problem we're finding is the following: that take the MREL requirement, which is an obvious principle. It's in the law. You should observe it. It's 8%. No one is entirely sure why it's 8%. It just is 8%, and it's 8% to allow you to access the Single Resolution Fund. By the way, you can bail in well beyond 8% if you want. I mean, I wouldn't recommend going too high, but you can go beyond 8%. The 8% is the trigger for access to the Resolution Fund. But there are banks in Europe whose market size, so let's take a Baltic bank, is a very big Baltic bank in a Baltic country, but does not have the size to access subordinated debt markets. Today, it probably does. But if we use the concept of the steady state, as we are supposed to do, in the steady state, they do not. Then you will have a more normal sloped yield curve. There'll be less risk appetite in the market. And for some of these banks, they simply cannot find access to subordinated debt at rates of interest that will be compatible with their business model. Then there are other banks that have business models that don't involve acquiring debt. Now, maybe, as I think was mentioned earlier, these business models should be eliminated. On the basis if you cannot access MREL, you shouldn't have that business model. This is not a view which is agreed across Europe. There are many countries, and not all of them, by the way, on the side of the risk sharing, let's say, who would be very strongly opposed to a model where a bank could not exist if it couldn't access MREL to a level of 8%. So what we're talking about, and we have not made any decisions around what we will do, is how you reconcile this problem that there are some banks for whom the 8% target and therefore access to Single Resolution Fund is not possible. And therefore, the bailing in of these banks becomes extremely difficult, because not only do they not have the amount of subordinated debt they need, but they may end up having to bail in liabilities that are either not desirable for reasons of stability or for societal reasons. On EDIS, I am very encouraged to hear that people have now moved to the point where they acknowledge that liquidity phase in principle can be constructed in a way where there can be no losses. This is something the Commission has been arguing, that we can construct this in a way where I will never say zero, but we can construct it in a way where the likelihood, the probability of loss is extremely low. It can never be zero. Why do we then argue that we need to continue and allow loss sharing if this can be reduced to zero? It is because if you don't have at least the theoretical proposition of loss sharing, it means that national DGSs, if they run out of money, will turn to the state again and not to the collective. And therefore you will again break the other principle, which is protecting taxpayers, because they'll go back to the state, but you'll also allow the doom loop to exist, to continue to exist between the national bank and the member state. I think this is a largely, it can be reduced to a large academic discussion if we get the liquidity phase right, but we would argue you still need that loss sharing step if your objective is to break that doom loop once and for all. I think also we have studies, and this issue of the distribution between national and EDIS is very interesting. We have studies that show that it's just a fairly truism that if you have a large block of money, it is more efficient in managing idiosyncratic crisis than if you have a smaller block of money. So we would argue, the ECB has shown this, that it's more efficient to have more of the money at the collective level. But this is again something which we can discuss at academic level. And on the RTSE, again, the Commission has taken a view on that we are not opposed to discussing it, not opposed to moving on it. But
in this roundtable, so if any of you wants to give a comment or ask something, we still have time for that. But okay, Leena, you are very active this morning, like always. So Leena, the floor is yours.
So sorry to be so active, but this is a excellent chance to talk to Sean as well about this. I mean, as he commented my steady state comment, I had to raise a hand one more time as there are a couple of minutes left. Yeah, I fully agree that the steady state sort of discussion is useless. However, the principles should not be. And I think we are in an agreement that the whole EMU would have been more stable had we had this sort of steady state, good principles in place on the banking union before we had the financial crisis. Perhaps the whole crisis would never have landed in Europe. So the principles matter, and what we are implementing does matter, and how we change the framework matters as well. So that's just a comment back to you that no, not the steady state, but the principles that we build on this banking union bits and pieces that we are now discussing. Just a comment on the 8%. If I remember correctly, it was Commission's own impact assessment where this would come, where this came from, and the idea was, I guess, that it would be enough to cover the losses of fallen banks in the previous crisis. But perhaps, Sean, if you still want to comment this, that would be interesting to hear it. Thanks.
Before giving the floor to John again, there is a question from my colleague from French Banking Federation, Benjamin Quatre. Floor is yours, Benjamin.
Thank you, Piia-Noora. Thank you for this lively debate. I have a question. I have seen that there are discussions between member states around the hybrid model, what we called in the past from the EDRIS. And do you think it's, after years of discussion, it's the way to find a compromise on this issue, or do you think it will not be a game changer, this discussion? Thank you very much.
I think it was for Mr. Berrigan, so you can maybe comment. Okay,
on the 8%. No, I mean the 8%. When I mentioned the 8%, I mentioned this idea that it's the gateway to the single resolution fund. There is no, as I said, there is no theoretical limit on the amount there is an effective limit on the amount you can bail in because you can destroy the bank, so which is not the objective of the resolution. But there's no specific limit on how far you can go. So you can go to 8%, as we know, then you can access the fund for a further 5%. And if you want to go above 13%, and it's possible without killing the bank, of course you can go there. The issue I'm raising is that this 8% is the threshold to access external financing. And sometimes this access to external financing is extremely important in managing the effective resolution. And the problem is that for some of these smaller banks, they may be able to raise MREL, but maybe not to the 8%. And then the question arises, well, if let's say they get to 5%, somehow they're excluded from access to the resolution fund because we have put this 8% threshold for access. So it's not that I question that there has to be a limit on bail-in. There is no limit on bail-in. The limit is, of course, the viability of the bank post-resolution. That is the theoretical limit. I think the hybrid model, yeah, I mean, as you know, we put a proposal in 2015, but in 2017, we put a communication on the table, adopted a communication in which we already indicated that we could envisage, again, as a transitional sort of approach, a hybrid model which involved both EDIS and national. Now, look, we have our own view of this. We think that theoretically, the most important way to construct EDIS, the most efficient way to construct EDIS is through a single deposit guarantee scheme, a single fund, and loss sharing with the liquidity part, which was always the case, by the way, liquidity part constructed in a way that the risk of losses are minimized to tail risks. We still believe that is the way, but we are realistic. We know that member states do not feel sufficiently confident in the model to move forward now. So we have already in the communication indicated that we could certainly support a hybrid model. We could support a liquidity first model also. So I do think that is a way forward. I think it's a way which in the beginning, many member states, I should by the way point out, never accepted that the liquidity was not an obvious loss maker. They used to claim that there was no difference between EDIS liquidity and EDIS loss sharing. I'm glad to see that the vast majority of member states now acknowledge there is a difference. The vast majority, there are still one or two who don't. So yes, I think there is a pathway here for EDIS. I think there's a path to get agreement. But again, I'm not going to pretend that it's going to be easy, even with the liquidity hybrid model. There's still a set of issues that have to be worked out. Nothing's easy. It's going to involve compromises on all sides. And I suppose the best thing is to remember that when you're having to make compromises, think of the compromises that are being made on the other side as well, because they're equally big and they're all based around the same principles.
Thank you. I think we have used our time for this morning on the topic. So I would like to thank all of you that you participated in the event and hope that this very fruitful dialogue with the European Commission will continue coming to the Euro Summit in June, and then of course later on in this year when we get more information on what is Commission's next legislative proposal on EDIS and crisis management framework. So I would like to thank you all for participation and wish that you have had a very interesting morning. At least I had a very interesting morning. I think it was 1.5 hours well spent on the topic, and I would like to still thank our speakers. So Mr. Berrigan, Mr. Heinäluoma, I see that you are back in the event, and then also Mrs. Mörttinen, thank you for your keynote presentations and fruitful and active discussion and comments. Thank you.
Bye-bye.
Bye-bye.
you